Ever placed a trade just to see the market immediately reverse on you? Chances are you were using your indicators wrong. The secret isn't knowing more indicators, it's knowing how to use the right type for the situation. Let's break down the 3 key categories. This image, titled Basic Indicator Guide, serves as a foundational map for navigating the complex world of technical analysis. It doesn't just list tools. It brilliantly categorizes them into 3 distinct philosophical approaches to the market, which is the first critical lesson for any trader. Understanding the purpose of an indicator is more important than knowing how to use it, and this chart lays that out perfectly. The first category, trend-following indicators, is all about identifying the market's primary direction. Think of these as your compass and map on a long journey. Tools like the moving average and parabolic SAR are not designed to pick the exact top or bottom of a market move. Instead, they confirm the trend's presence and help you stay positioned in the direction of the prevailing momentum. A moving average smooths out price data to create a single flowing line, making it visually clear if an asset is in an uptrend or downtrend based on the price's position relative to the line. The parabolic SAR, often seen as a series of dots above or below the price on a chart, provides a dynamic framework for the trend, with the dots indicating potential reversal points and acting as a trailing stop loss. The crucial insight here is that these indicators work best in strong, sustained trending markets, but will give false whipsaw signals during sideways, choppy periods. The second group, momentum indicators, shifts the focus from direction to strength. These are the market's pulse and breath, answering the question, is this move powerful enough to continue, or is it running out of steam? The RSI, Relative Strength Index, and MACD, Moving Average Convergence Divergence, are the quintessential examples. The RSI operates on a scale of 0 to 100, measuring the speed and change of price movements. It identifies conditions where an asset is potentially overbought, often above 70, and due for a pullback, or oversold, often below 30, and potentially ready for a bounce. The MACD is more complex, showing the relationship between 2 moving averages of an asset's price. It helps traders spot changes in the strength, direction, momentum, and duration of a trend. While trend-following indicators tell you where the market is going, momentum indicators warn you if the engine is about to stall or reverse. Finally, the chart lists volatility indicators, a category left intriguingly blank. This blank space is, in itself, a powerful teaching moment. Volatility indicators measure the degree of variation in an asset's price over time, essentially the size of its price swings. In a low volatility environment, price action is calm and range-bound. In high volatility, prices can make large, explosive moves in either direction. Indicators like Bollinger Bands or the Average True Range ATR would fit here. They are vital for risk management, as they help a trader set realistic stop-loss and take-profit levels based on the asset's current temperature. High volatility means wider stops are needed, while low volatility can signal that a period of explosive movement is imminent. This image provides a clear and actionable trading guide for the stochastic oscillator, a classic momentum indicator. The guide is effectively split into 2 distinct trading strategies, one for entering long positions, buying, and another for short positions, selling or shorting, each with its own set of rules. The core principle of the stochastic is that it measures the location of a security's closing price relative to its price range over a set period, oscillating between 0 and 100. The key zones defined are the oversold zone, at or below 20, suggesting potential upward momentum exhaustion, and the overbought zone, at or above 80, suggesting potential downward momentum exhaustion. For a long position, the guide outlines a multi-layered confirmation process to increase the probability of a successful trade. First, both the fast %K and slow %D lines must be in the oversold zone. This indicates that the selling pressure may have been overdone and a reversal to the upside is possible. However, being oversold alone isn't a signal to buy. An asset can remain oversold in a strong downtrend. Therefore, the second rule requires a bullish crossover, where the %K line crosses above the %D line. This signals that positive momentum is beginning. Finally, and crucially, the guide adds a trend confirmation filter. The price must close above an EMA, exponential moving average. This ensures that the broader trend is aligning with the bullish momentum signal, preventing you from buying into a counter-trend bounce that is likely to fail. Conversely, the rules for a short position logically mirror those for going long. The process begins with both stochastic lines residing in the overbought zone, implying the buying momentum may be peaking. The trigger is then a bearish crossover, with the %K line crossing below the %D line, indicating that negative momentum is starting to build. Finally, to confirm the move isn't just a minor pullback within a larger uptrend, the price must close below an EMA, confirming a shift in the short-term trend structure. This image, titled Spotting Trends with RSI, presents a sophisticated and highly practical method for using the Relative Strength Index, RSI, that goes far beyond the basic buy at 30, sell at 70 rule. It teaches us to interpret the RSI not just as an overbought, oversold gauge, but as a dynamic map of trend momentum and structure. The core idea is that the level at which the RSI oscillates during a trend can provide powerful clues about the trend's health and potential continuation. The guide outlines two primary scenarios. The first is identifying bullish momentum and preparing for a long position. In a healthy uptrend, the RSI will typically oscillate in the 60 to 80 range. This is a critical insight. Instead of immediately selling when the RSI hits 60 or 70, we recognize that in a strong bull market, the RSI can remain elevated, overbought, for extended periods as buying pressure persists. A dip to 60 in an uptrend acts as support. The image also notes a condition where the RSI is between the 40 to 60 level, which often represents a neutral or consolidation zone, and another where the RSI is below 60, which could signal a weakening of bullish momentum unless it's a temporary pullback. Conversely, for bearish momentum, the RSI will characteristically oscillate in the 10 to 60 range. This flips the conventional wisdom on its head. In a sustained downtrend, the RSI will struggle to reach the 60 level, and the 50 level often acts as resistance. The oversold territory below 30 becomes the area where the indicator hovers during the most aggressive sell-offs, but a bounce only back to, say, 50 indicates ongoing weakness. This helps traders stay in a short position or avoid premature long entries, understanding that the trend is still bearish as long as the RSI cannot break and hold above 60. Finally, the image includes a specific entry trigger. Price closes above engulfing, which refers to a bullish candlestick pattern. This combines the trend-spotting power of RSI levels with a concrete price action signal. The overall system painted by this guide is a powerful one. First, use the RSI's oscillation range to determine the dominant trend, bullish above 60, bearish below 60. Then, within that context, use traditional price action patterns like engulfing candles to time your entries in the direction of the established trend, thereby significantly increasing the probability of a successful trade. This image, titled 6 Entry Methods, provides a powerful and concise summary of the most reliable technical analysis concepts used by traders to time their market entries. It moves beyond indicators and into the core of price action analysis, focusing on how to enter trades based on the market's own structure and behavior. Each method represents a distinct scenario where the probability of a successful trade is often heightened. The first method, trendline reversal and break, involves drawing dynamic lines along the peaks and troughs of a price chart. An entry is triggered when the price either breaks decisively through a trend line, signaling a potential trend reversal, or bounces off it, confirming the existing trend's continuation. The second method, support and resistance, is a foundational concept where price tends to react at certain horizontal levels. An entry is initiated when the price bounces off a support level for a buy or rejects from a resistance level for a sell, or, more aggressively, when it breaks through one of these levels with conviction. The third method, Fibonacci retracements, is a tool for identifying potential pullback levels within a larger trend. After a significant price move, traders draw Fibonacci levels, like 38.2%, 50%, 61.8%, to anticipate where the price might retrace before continuing in the original direction. An entry is taken when the price shows signs of stalling or reversing at one of these key levels. The fourth method, consolidations, involves periods where the price moves sideways in a tight range, indicating a balance between buyers and sellers. An entry is triggered on a breakout from this consolidation pattern, signaling that one side has won the battle and a new directional move is likely beginning. The final two methods involve more specific market phenomena. Gaps are areas on a chart where no trading has occurred, often seen after a weekend or major news event. Traders enter based on the filling of the gap or a breakout in the gap's direction. Lastly, volume climax and trend uses trading volume as a key signal. A climax is an extreme spike in volume that often signifies a potential reversal point, exhaustion of a move, or the confirmation of a new trend strength. An entry is based on the price action that follows this volume spike. In essence, this chart provides a trader's toolkit for finding high-probability entries by reading the story that price itself is telling. This fifth image outlines a precise and systematic approach to using the Average Directional Index, ADX indicator, to trade strong trends. The core philosophy here is that the ADX itself does not signal direction, but rather measures the strength of a trend, with a reading above 25 confirming a market is trending strongly enough to warrant a trade. The actual entry signals come from the directional movement lines. A long position is initiated when the pulse DI line crosses above the DI line, while a short position is taken when the plus DI line crosses below the DI line, but only if the ADX is 25 or higher in both cases. The strategy is rounded out with a clear and disciplined risk management rule, using the low of the entry candle as the stop loss for a long trade and the high of the entry candle for a short trade, making this a complete rules-based system for entering and managing trend-following positions.